Hello everyone, welcome to D Street School. Today we are going to discuss about a very interesting and important concepts, none other than volatility. Before we go and dig deeper, are you the one who always disappointed with your stop loss, which is always triggered before price moves as your expected direction? Have you ever thought about why did your stop loss always triggered alone when compared to your friends? If you don't have an answer with you, don't worry, you will get an answer in this video. My name is Shivagurunathan. I'm going to be with you for next 15 minutes. Please do watch the entire video. First, let me give you the overview about the video. What are the concepts you will be learning here? So before that, I intend to create this video. If you're following my videos regularly, I used to give the volatility range in all my trading calls. It's very hard to explain what is volatility, what is the thought process behind that. So how we will go and understand the volatility range, explaining in all my videos, it consumes a lot of time. So I come up with the idea to create a separate video for volatility that really help us to reduce a lot of time. So that is the idea behind to create a separate video for historical volatility. Here we will be and learning what is volatility, why it is important. So what is the thought process behind this volatility? Usually I provide the volatility range in all my training calls. So how we will understand this volatility range? And finally, how we can go and place the stop loss order by using this volatility. These are the concepts we will be discussing in this entire video. Let me go and start with what is volatility. What is volatility? Volatility captures the price movement of the stock or index at any point of the time. When I say any point of the time, we will go and calculate the price range for yearly basis, weekly basis, monthly basis, or even we can do it for daily basis too. We can go and customize as per our needs. Volatility is a statistical concept. I'm sure you might read those concepts in your high school days, like what is standard deviation, variance, covariance, mean, median, etc. So don't be scared. Here we are not going to do any calculation part, neither of the concepts. All we will be discussing about the thought process behind those concepts. So let me tell you what is standard deviation. Standard deviation is it's we can go and capture the what is the possibilities of the event likely to occur. When I say standard deviation 1 is the estimated price range, and there are 68% of possibilities where the stock or index are likely to trade in that range. So it shows a confident level. When you go and increase the standard deviation, so which means standard deviation 2, so that would be the range estimated, the price range where 98% of the possibilities the stock or index likely to trade. When I say standard deviation 3, so again 99% confidence where the stock or index likely to trade. When you go and increase the standard deviation, it increases ranges. So there will be a lot of possibilities that event or price might trade within the particular range. So there will be 3 types of volatility: historical volatility, forecast volatility, implied volatility. Here we will be discussing about only historical volatility. For implied volatility, usually you will find in option chain. So in case if you want to learn about what is forecast volatility and implied volatility, just ping in the comment section. I will create a separate video for that. So today we will be discussing about only the historical volatility. What is historical volatility? By using the past price of the stock or index, we go and calculate and estimate what would be the likely range the stock or index will trade. It's called historical volatility. I will give the example for that. This is the template I use to give volatility information in all my trading calls. Let me explain how we will go and interpret the information from this template. I took it as a sun farmer as an example. This is a dummy values. Don't go with this value. This is only for example purposes. So a sun farmer closing price would be 667 rupees 90 paise. That was the last closing price, and the average price movement of the sun pharma would be 14 rupees 35 paise. This is the data we calculated for the last 1 year. So sun pharma averagely trading of 14 rupees 35 paise. So this is the volatility levels which I given for next 5 days. I mean the historical volatility level. Here you can find R1, R2, S1, S2, which is not typical support and resistance. So this is the standard deviation 1 and 2 in order to understand easily. So I named it as R1 and R2, S1 and S2. So R1 and S1 is the standard deviation 1, R1 and S2 is the standard deviation 2. I have not included standard deviation 3. So as we know, what is standard deviation is the estimated price range. There are 68% of the possibilities where the stock or index are likely to trade. So by understanding the standard deviation one, so we know there is a 68% of the possibilities Sun Pharma will trade between 657 to 680 the price range. So we have a 68% of the possibilities. Of course, the remaining 32% of the possibilities, there might be a chances Sun Pharma might trade outside of the range, either upside or downside. So again, if you want to increase our confidence level, you can go and opt for a standard deviation 2, which is R2 and S2. If you go and see R2 and S2, the trading range would be 645 to 693. So almost 50 points there will be a difference. So I can tell you 95% confidently Sun Pharma will trade within this range from 645 to 693 for next few trading session. So there will be a very few chances Sun Pharma might trade outside of the range, either upside or downside. That would be the 5%. So this is how we will go and interpret the information through this table. So in order to make you understand better, so I made it at a graph. These zigzag lines are the daily returns, and this is R1 and R2, S1 and S2. So this is the standard deviation 1, this is the standard deviation 2. So by understanding this concept, we can conclude while increasing your confidence level or opting for a higher standard deviation, you have a huge variance. So I would recommend you to go and stick with standard deviation 1. So I mean minimum start with standard deviation 1, because the average price movement of the Sun Pharma would be 14 rupees 35 paise. If you go and see the range of the standard deviation would be from 657 to 680, that would be hardly come like 23 points. So there will be a lot of chances Sun Pharma will trade within this range for next few trading session. By understanding this concept, we can go and customize our trade, especially when option trade. That will really helpful to pick at which strike at which strike price we can go and opt for it. So that is the main reason volatility is very important. So when you know the price range of the stock or index, you can go and opt for the best strike price. So for example, I can tell you 95%, I can tell you Sun Pharma will not trade above 693 level. So in case if you want to make a short, you can go on short above 700 level. So this is the best strike price for you. So because 95% the stock will not trade above 963 level, so you can go and initiate a short call, and you get a good premium, decent premium on it. Finally, we come to how we can go and place the stop loss order by using the volatility. So I will tell you in very simple manner. So first you have to decide your entry price and minus the volatility percentage. So in order to understand you better, so here I gave you in percentage. So the next 5 days the volatility percentage of the sun pharma is 1.78 percentage. By knowing this percentage we will go and subtract it from our entry price. For example, if our entry price would be 670, so as we know the volatility percentage would be 178, I mean 1.78%. So when we go and subtract it, so we have to subtract 11 rupees 93 paise. So we can go and place our stop loss below 609 658 levels. So okay, this is how you can go and place your stop loss level. So I'm sure most of you come across the situation, we once we go and place the stop loss order, price all the way come and trigger our stop loss, then it will go to as our predicted market direction. It happened to me when I was in a initial stage of my trading. So later I come to understand the importance of the volatility. So after that I know so what would be the range the stock or index likely it's going to be traded. I'm sure this concept will be very useful for you. Again, before I go and conclude Sun Pharma data is for example data. This is not a today's data. I mean the previous close data. This is 2 weeks before data. Just I the intent to show this template make you understand better. So this is all I wanted to communicate with you. I hope you understand all the concepts better. In case if you do have any queries or questions, don't hesitate. Please do ask in the comment section. Again, if you like this video, please go and click the thumbs up button and go and subscribe to this channel. Thank you guys. We will be seeing in another video. Till then, bye from Shivagurunathan.